2023 has perhaps been a better year in markets than many expected. As the year draws to a close, we'd like to share with you some insights as to where investors are putting their money. Aggregate ETF flow data, that is the net of all investor buying and selling activity, can show us where investors are seeing opportunity and can uncover interesting trends in how Australians are seeking to build investment portfolios. The total net inflows for ETFs in Australia for the year to 30 November 2023 was approximately $14 billion, a respectable increase on the full year 2022 figure of $13.5 billion. Unlisted funds, on the other hand, look likely to finish the year in net outflow again, which would be the second consecutive year of net outflows. The majority of assets under management in Australia still sit within unlisted funds. However, the net flows show us that ETFs are making inroads. As at the end of November, the leading ETF issuer by net flows was Betashares, with an Australian ETF market share of nearly 40%, followed by Vanguard with approximately 30%. We'll wait to see if Betashares can hold on to its number one position to the year end in December. There has been a noticeable shift in the ETF asset classes which have received flows in 2023. Cash and fixed income took in $6.1 billion, or 44% of total flows. Cash and fixed income have been growing year on year from being practically an afterthought 5 years ago. Australian equities captured about a third of total flows. International equities took in only 20% of total flows. Quite interesting, as over the longer term, international equities have tended to be the most popular asset class for ETFs. Changes in monthly ETF asset class flows can also tell us something about how investors' risk appetite has shifted over the calendar year. It was a tale of two halves. The first 6 months were dominated by fixed income and cash, with fairly consistent, even split between fixed and floating rate exposures, while there were muted positive flows into Australian equities and net outflows from global equities. This is indicative of a generally bearish outlook in the first half, with a preference for defensive assets over growth and a home country bias. When Australian investors feel risk averse, they often believe the risks are greater offshore than at home. In the second half of the year, we saw a change in sentiment. Inflation appeared to be coming down, while the strength of the US economy surprised on the upside. This change was reflected at first in stronger flows in Australian equities from August, and then finally international equity flows picking up from there. These larger flows into equities did not come at the expense of cash and fixed income, which continued to take in more money throughout the year. In fact, the average monthly flows in the second half of the year has been roughly double that of the first half. So where have people invested within the major asset classes? Many investors have sought to take advantage of the higher interest rate environment. ETFs such as Betashares Coupon and AAA saw significant inflows over the year. But we also saw an increasing number of asset allocators seek to take advantage of the choice now available in fixed income ETFs. Just over $1 billion was invested into US Treasury bond ETFs. In Australian equities, the vast majority of inflows were into three low-cost broad market beta funds, including Betashares Australia 200 ETF, A200. The increasing scale of these funds allowed for reductions in fees in 2023, meaning A200 remains the lowest cost Australian equity ETF, with management fees of now only 0.04% per annum. In international equities, there was reasonable support for index and smart beta ETFs. However, very significant outflows from actively managed ETFs offset much of this at an asset class level. One emerging trend late in the year has been investors seeking to allocate to currency hedged international equity ETFs to mitigate the risk of a rising Australian dollar. Approximately half of all international equity flows in November were for currency hedged funds, well above the long-term average. Turning now to performance. In terms of broad market core equity ETFs, 2023 performance outcomes were largely determined by each fund's allocation to tech as a sector and growth and quality as a factor. NDQ was up nearly 50% for the year, as at the end of November, and growth-oriented, actively managed international equity funds staged a recovery after a tough 2022. Speaking of having a tough 2022, crypto-related ETFs all had strong returns in 2023. Betashares Crypto Innovators ETF, CRIP, which invests in companies involved in servicing crypto asset markets or which have material investments in crypto assets, has been the best performing ETF in Australia for the year to the end of November. We do note, however, that CRIP is still significantly down since inception, and it remains a very volatile investment and should be considered only by investors who fully understand the features and risks of such an investment. While thematic ETFs exposed to renewables and energy transition metals generally perform poorly, the increasing focus on uranium's role within the future energy mix saw Betashares Global Uranium ETF, URNM, do very well during the year. As 2023 draws to a close, US equity market volatility is as low as it's been since before COVID. Let's hope this year in markets is remembered as the one where central banks managed to get inflation under control without tipping the economy into recession. But you never know what next year might bring. In any event, we believe the key to building wealth is creating a long term investment plan and sticking to it over the cycle. We believe ETFs offer an excellent tool for building low cost diversified portfolio in all market conditions. And based on the flow data, it would appear that more and more Australian investors are seeing the advantages of ETFs too. On behalf of everyone at Betashares, thank you for your support in 2023, and we hope you enjoy your holiday season.